Hello, everyone. We wanted to take a quick moment to thank you all for joining us today. This podcast was recorded and is made available to you by Whitley Penn LLP and WP Wealth LLP solely for informational purposes. The information, views, and opinions expressed in this podcast are general in nature and are not intended to be construed as the provision of financial or investment advice by Whitley Penn or WP Wealth. The information discussed in this podcast is accurate as of the day it was recorded, but may then become outdated over time. Please feel free to contact us if you have any questions, comments, or concerns in regard to the content presented. Thank you again for tuning in, and we hope you enjoy this episode.
Hello, and welcome back to the next installment of Start Now, Success Later. My name is Brandon Russ, and I'm an associate advisor at Whitley Penn in the WP Wealth Group. On today's episode, we're going to dive into the basics of investing. I think right now this is a topic a lot of people are interested in, and I'm really glad we get to take a look at it. I'm joined today by my colleague and senior manager at WP Wealth, Bill Weston. Bill, how's it going today?
I'm doing great, Brandon. Thanks for having me.
No problem. Thanks for coming on. Would you mind quickly introducing yourself and kind of explain what you do here at WP Wealth?
Yeah, so I'm a senior manager here at WP Wealth. I've been in the financial services industry for over 10 years now. Spent the first half of my career with a large publicly traded asset manager, and then have spent the second half and continuing to do so here at WP Wealth as a senior wealth manager, working with closely held business owners as well as households and individuals to help with their overall financial well-being.
All right, so it kind of sounds like you know what you're talking about when it comes to investments, right?
I would like to think so.
That's good. So in general, when should someone begin investing? Or I guess around what age or stage of life do you see most people begin investing?
That's a great question. And you know, I don't know if there's really any one right answer or a one-size-fits-all for an individual or a household. There's a lot of personal and unique circumstances that need to be considered and taken into consideration when deciding if it's a right time to begin investing or some sort of investment program. And I think one of the biggest changes within the investing environment or overall capital market dynamics is the accessibility to investments. That's changed quite a bit. You know, it used to be just 10 years ago, you would actually physically have to fill out paperwork, send that in. You could fax it. Potentially at that point in time, you could email it or submit that electronically. But now, I mean, it's as easy as downloading an app and depositing $10 and getting a bonus of $5 for referring each one of your friends for each one that signs up. So I would say, you know, to answer your question specifically, you know, it's a wide range. It just depends on each individual's personal situation as to when it allows for them to start investing.
Yeah, and I think you're definitely right. You know, in the last few years, Robinhood has really kind of broken down the barriers for people to get into investing. The fractional shares, no trade costs, like you said, that was unheard of 5 to 10 years ago. And they've kind of forced all these other brokerage firms to kind of follow suit. And now with all this accessibility, people are younger and younger getting involved. You know, whether that's a good thing or not, we'll kind of get into that a little later. But you definitely see more and more retail investors entering the scene. Do you ever see like a common theme or a driving factor that really gets people involved in investing?
Usually there's some sort of catalyst that either requires or sets up a meeting with us or just generates any sort of interest in investing for an individual. But usually what's behind that, it's all the same. It's, they're trying to protect their purchasing power, and they're doing that by taking an additional level of risk with the hopes of a greater reward at some point in the future, and that reward being something greater than what their savings or checking account provides for them today. So yeah, it could be something like I want to save for my kids' education. I want to save to purchase my first home. I'm intending on buying out one of my business partners to take full ownership of my business or a greater ownership of my business. So it just depends. Again, a lot of this is very unique to an individual's personal circumstances.
Yeah, and I did touch on this in a previous episode. We do always still recommend paying off high interest rate debt first before you do begin investing, outside of your 401k, of course. But you're definitely right. When people have goals like saving for a house or buying a larger part of their business, that's definitely when we see people kind of upping their investments. So with these newer investors, people who are kind of inexperienced, do you see a lot of common mistakes they make?
Yes. I would say the biggest mistake that most investors make is a lack of diversification. And I think that's there's a number of different factors that play into that. I think the biggest of which is the headlines. Take for example GameStop. Take for example just any or cryptocurrency or any of the other Wall Street bet stocks that were put out there. That's the emotional allure and attachment that I think a lot of investors get initially attracted by, and they want to be a part of that movement, and that almost that get rich quick component that they're seeing advertised and marketed in the news, that so many different investors have made millions overnight just looking at these different names and these different things like Bitcoin or Dogecoin. The different cryptocurrencies have created that same type of get rich quick components that people believe they can capture, but that's not always the case. In very small instances, yes, but that's very difficult to be on the forefront of that and get out in front of all of that that trading power that drives those prices upward. One of the other, so really just diversification. I think that investors will try to participate in an event like that, but they dump all of their money into that one particular name, hoping that's going to make them, hoping that's going to grow their wealth substantially in a quick period of time. The other part of that chasing headlines, that's the other big mistake that I see investors or amateur investors make in trying to grow their wealth. So they kind of go hand in hand. As it relates to diversification, there's layers to that diversification piece, because you can have an investor who decides, okay, well, yes, I want to take a risk with something like GameStop or a cryptocurrency, but then they have some other names that they do feel will grow in value and have a positive impact on their portfolio. But usually that settles in between and focuses on a subset of domestic stocks. And they're eliminating a significant segment of capital markets and opportunity that's out there to grow their wealth meaningfully by having exposure to smaller cap names that 99% of the world, if you were to say their company name, nobody would know what they do or what industry that they're in. you have international names, both domestic and emerging market, uh, uh, developed market and emerging market, excuse me. And then you also have fixed income, and cash alternatives. People don't think about that when they're investing. I bet if you went out and asked anybody, when's the last time you purchased a bond, there's no way. There's no way that any individual investor or introductory investor has gone out and made that purchase.
Especially under the age of 30.
Yeah, exactly. There's no way, no chance. And then you start throwing in alternatives, things like real estate and other alternatives. So there's a wide range of diversification that gets overlooked, and there's a lot of concentration risk at the end of the day.
So both of those, chasing headlines and diversification, are mistakes we not only see new investors make, but longtime investors as well. And as it pertains to chasing headlines, it's really the sheer threat of new tax legislation or the excitement of a potential SPAC merger that we've really seen wild market moves for really no reason. And usually when you do that, you wind up being late to the party and you miss the run-up you were hoping to capture anyways. So really, it's just best to tune out the headlines in general. I always think it's best to do your own due diligence and really develop your own conviction. But as far as asset classes go and diversification, can you kind of touch on that a little more? Why is it really important to spread out the risk? In my mind, I like to think of risk as a ball of Play-Doh. You can push it down and spread it out, but that risk will always still be there when it comes to investing.
Yeah, and so most investors, that if they are educated on diversification and the benefits of a diversification portfolio, it's usually limited to something like a domestic index, and that comes in the form of the Dow Jones Industrials Average or the S&P 500 is typically what we see. And the reality of it is those aren't necessarily diversified portfolios. You're still only capturing a very specific subset of capital markets when there's a whole literally world of opportunities available to them. And what I mean by that is both the Dow Jones and the S&P 500 are purely domestic equity or stock exposure. And to take this a step further, not only are you limiting your geographical exposure and not having any sort of investment in international developed countries or emerging markets, but you're missing out on the capitalization structure, the small and mid-cap names that tend to offer a greater risk premium associated with those names as well. And let's take the S&P 500, for example. If you were to invest all your money in the S&P 500, you're going to get 50% of your investment exposed to the 50 largest names within the U.S. The other 50% is going to be made up of the other 450 names. So you can see there's a disproportionate allocation that favors those large cap, more household-like names. I mean, if you ask an investor, they would probably at least recognize the logo or the name or what type of industry or product that they sell. But the other 450, where that risk premium historically has provided, most investors aren't going to be able to identify with many or any of those names. And then beyond that 450, there's at least another 2,500 names out there from a domestic equity perspective that are available to invest in and provide exposure to those additional risk premiums. And so that's why it's important to take a greater picture and understand diversification at a greater level, because the investor themselves is missing out on an opportunity for return and may actually be taking a greater level of risk in achieving less return in doing so.
Right. And, we don't expect you to, find a little diamond in the rough and invest in that and make your millions off of that. That's kind of really where the professional investors step in. They're doing research all day, all night, finding those companies that have yet to take off. But how can a standard investor, someone who's new, doesn't really know, can't do all that research themselves, really get into those smaller names and kind of get exposure that you're looking for?
I think that's where it becomes a question to yourself: is how much guidance do I need? And that's realistically, that's difficult to perform research and understand the fundamentals, the balance sheet of this wide range of opportunity set that's available to an investor. And that may come in the form of meeting with somebody like us, or creating a more efficient research process for yourself. Now, again, that's going to be very difficult, but I think for the most part that leads to having a conversation with an advisor or an investment professional about how they can help. And typically where that starts is to help institute things like diversification within a portfolio and limit the chasing headlines mistake. It's working with a client to develop conviction. You talked about conviction earlier in your investment process. It's working with a client to develop conviction in their investment process. Well, how do we do that? Well, we turn it around and we don't so much focus on the investments and the opportunity of the investments themselves. We focus on the individual and that household specific goal set and needs. And because if you can relate your investment plan to something more personal, that's what's going to provide you that conviction. And that's what's also going to transition from what I believe they're calling it these days is the attitude of paper hands, and transition that into a diamond hand.
HODL.
A HODL, exactly. Investment program. And so that's where a group like ours, working with an individual, can be helpful, is developing that investment plan, giving them the conviction in their investment, instituting those different elements like diversification, and leaving emotions out of your investment process that have typically provided for a more successful outcome.
So does someone always need to hire professional help? I mean, Bill, you're pretty good at what you do, and that comes with an expensive price tag. So should someone with $5,000-$10,000 really be looking to hire a professional?
It depends really what the individual is trying to accomplish, and you could also, if you're in financial services, there's a lot of layers to financial services, but that could come in the form of, you may need some guidance, but you don't necessarily need all the guidance that we offer. So it really just depends. And as it relates to a price tag, there's a lot of different investment managers, financial advisors out there that provide different types of cost structures. So, even if we may not be a good fit for you yourself, there's likely somebody or something, some service out there that is probably a good fit and will meet your needs.
There's also Robinhood, Fidelity, TD, the apps that kind of give the retail investor an easy way to get into the market. I don't personally think that Robinhood is really the best route, but as we did say before, they did kind of break down a lot of the barriers and get people investing in general. So if I am using an app like Robinhood or Fidelity or TD, what should I be weary of when I'm just starting?
I think that all goes back to what you're looking for in a relationship and the support that you're going to need for your investment future and your investment plan. Working with somebody like WPWealth, we're very hands-on. Typically, we're local. That's not exclusive, and especially with the acceleration and use of virtual meetings. That gives us the opportunity to be just about everywhere whenever we need to be. But it's also a familiar voice, a familiar relationship that you know you're going to get a dedicated team working on your portfolio, working on the different financial projects and analysis for your needs, that you can pick up the phone, send an email, and you're going to get a response quickly. Whereas if you work with a bigger firm, let's say one of the bigger brokerages like a Fidelity or a Charles Schwab, you may not get the same name. You may not get that dedicated team. You may get the customer service that's not even remotely close or domiciled in the United States, that might be outsourced somewhere else. And in the case of Robinhood specifically, there is no phone number. There is no phone number that you can call and reach somebody. It's all, my understanding, just an input that you need help and that you'll be contacted at some point to help you with your service needs. And so in making a decision about who you're going to work with, it's important to understand the service component, the service component of that, and where your comfort level is.
Yeah, and back to what you're saying with Robinhood's customer support or lack of, that's definitely something you need to be wary of. The market moves fast and it's not going to slow down for you. So, if you have a problem, you kind of need to know or be able to figure it out pretty quickly. I'm sure a lot of people have heard this, but Robinhood was in the news probably early 2020. They had a 21-year-old who was investing on their app, which is pretty much the demographic for most of the app. And he was led to believe that he had a $750,000 margin call through trading options. Now, in my personal opinion, Robinhood gives people who have no business trading options the ability to trade options, but it kind of led to this kid having no idea and seeing this $750,000 margin call, and he freaked out. And by the time he reached out and heard back from Robinhood, it was too late and he killed himself, which is terrible, and that shouldn't happen to anybody. But it is something that you need to be aware of, and you need to know what you're investing in and potential ups and downs of that investment.
Absolutely tragic. But again, I think that highlights the importance and the impact of just having a familiar relationship dedicated to your account. And one, how on the forefront there could be education provided to limit that options and margin trading exposure, but also just corrective action quickly, and in knowing that that was truly a mistake, what was being reflected on the account, and getting to the bottom of that before a tragic event.
Right, and what was kind of crazy about all that was, he wasn't even subjected to that margin call. It was a glitch. So, again, we can't stress enough that when you're investing, you have to know pretty much everything that you're investing in. But kind of transitioning here, I want to touch on ETFs and mutual funds. ETFs and mutual funds have gained a lot of popularity recently, probably in the last 5 to 10 years, with index funds and all that kind of stuff that you were kind of touching on. Can you explain the difference between ETFs and mutual funds? I've heard the term used interchangeably in the past, and I know that that's not true.
So both an ETF and a mutual fund, they accomplish similar goals. You're going to get a diverse basket of positions, so you're helping that institute that diversification element within a portfolio. But they go about it in different ways. And it's really the underlying mechanics that make up an ETF and a mutual fund that make them differ. A mutual fund is a basket of stocks or securities that prices out once daily. So if you place a purchase or a sell order, you have to wait until the market close, and then there's going to be a level of fund accounting that takes place, and the value of that basket of securities at the end of that trading day is what you're going to get for the value of your redemption or your purchase. An ETF, also a basket of stocks or securities, is actually traded intraday, just like an individual stock would. And so you're going to get price fluctuation throughout the day. Now, in trading both of these, the mutual fund is a little simpler, obviously, but in trading the ETFs, there's some components of a bid and ask price that you now have to worry about that could create more trading costs associated with trading the ETFs. You also need to be cautious in placing those orders, not necessarily with a traditional market order, because there's room for you to be taken advantage of in the open market. So understanding the different type of orders that you can place within the marketplace and using ETFs is important if you're going to start trading those. Now, let me take a step back here and touch on more of the underlying investment selection within ETFs and mutual funds. So mutual funds, they can come in the form of an index as well as an actively managed fund. So that's where you have a portfolio manager or a subset of portfolio managers who are making decisions on buy and sell orders within that mutual fund each and every day. You also have index-like mutual funds. So if you just want to own the S&P 500, you can buy a mutual fund that comes as the S&P 500, and their mandate is to replicate that S&P 500 index as best as possible. But an ETF, those were introduced as index proxies. Really, those were meant to efficiently capture an index. But that has evolved since the introduction of the ETF, and you now actually have some actively traded ETFs that are available within the marketplace. So traditionally an ETF, more index-like, still because of the mechanics of the ETF, even with the active component of it, there is a level of an index tie to a lot of the offerings that are out there. So just depending on what you're looking for, how you're looking to trade, you can still accomplish a lot of the same things by buying an ETF or a mutual fund. But again, it all goes back to your own personal level of comfort and how you want to organize and set up your investment portfolio.
And as a new investor, ETFs and mutual funds are pretty good to kind of cut your teeth on. The prices don't move based on supply and demand like stocks. It's more of the underlying securities involved. So you're not going to see the massive fluctuations you could with one stock position. And you also will get the diversification that we talked about earlier, because it has a bunch of underlying names that you maybe haven't even heard of before that are just kind of in there because they're following that index. So definitely something to look out for and keep your eye on. Research on those. I know they're pretty big right now. All right, so let's begin to wrap this up. We'll do so by touching on the taxation aspect of investing. So let's start with account type. There are a few different accounts you can choose from when you begin to sign up. In what circumstances would you use an IRA as opposed to a brokerage account, and vice versa?
That's a great question, Brandon. And I think what gets often overlooked by investors is the tax implications associated with the acquisition and disposition of really any sort of investment. But as it relates to your question, again, it all goes back to the individual needs and goals for whatever it is that they're trying to accomplish. And I think that goes in understanding the different consequences associated with tax, but also any sort of potential penalty that could be incurred for a withdrawal, or an early withdrawal, I should say, from these tax preferred styled accounts for retirement. And so if you're just trying to invest for, let's call it a short, mid to mid long term horizon, and use those dollars for a goal within that time frame, you're likely only going to want to use a general brokerage account. If you're married, you can do a joint investment account to have both husband and wife's name on there. But understanding that the trade-off in only using a general brokerage account is you're going to subject yourself to capital gains, and you're going to establish basis from your principal investment. But any sort of subsequent sale that takes place and earnings associated above the basis that you've established are going to be subject to your capital gains tax rate. And that capital gains rate also toggles between short-term and long-term capital gains being assessed. So depending on your holding period, if you're trading in and out of stocks each and every day, you're going to subject yourself to potentially a high level of short-term capital gains tax, which, as it relates to you personally, would be subject to your whatever ordinary income bracket you're subject to. However, if you are more of a buy and hold strategy, you're getting
hodl.
Hodl. If you're more of a buy and hodl or somewhat of a diamond hands, you're going to be able to realize capital gains tax at the long-term preferred rate. So lower, most likely lower than your ordinary income rate that you would otherwise be subject to. So understanding those tax consequences are important in not only making your buy-sell decisions, but also the timing of those buy-sell decisions, and all in consideration of your future liquidity needs, whether it be a short, mid to long-term goal set of yours. Now, you would look to use an IRA mainly for retirement. If you intend or end up having to pull out funds from your IRA before 59 and a half, you're going to be subject to ordinary income. You're also going to be subject to an early withdrawal penalty on those assets as well. So understanding those consequences, as well as the differences in being taxed as ordinary income in every situation, as opposed to your gains only being assessed tax on the general brokerage account.
So to kind of summarize that really quickly, short-term goals, probably individual brokerage account is best. Long-term / retirement, probably IRA is the best. And holding period does matter. Short-term would be less than 1 year of holding it. Long-term is more than 1 year of holding it. And that kind of ties into what a wash sale is. Can you kind of go into that, explain to us what it is, why is it important to avoid a wash sale?
So some folks, as an investment strategy, will incur losses intentionally to help offset other gains that they have already realized or are in anticipation of realizing future capital gains. And the wash sale ties into eliminating or disallowing a loss that you have realized that you could have otherwise used to offset a capital gain, and help manage or mitigate your overall tax obligation due to your trading and the trading consequences associated with that. So a wash sale basically is an elimination or a disallowance of that loss that you would be creating or realizing to help with offset the gains.
Yeah, most commonly you see this with day trading, and we don't really recommend day trading, so you should try to avoid this as best you can. But if you are buying and holding, then you really don't have to worry about this. Bill, thank you again for coming on. Do you have any final thoughts to wrap this topic up?
No, I thank you for having me today. And as it relates to taxes as well as investing, that's where WP Wealth, as well as the tax department here at Whitley Penn, working with them hand in hand and helping coordinate both of those professional services tends to give us an edge and opportunity to help clients in a way that's more coordinated in providing them a more successful outcome. So I encourage you all you listeners out there, if you have any questions about investing or taxes, please get in contact with your respective professional, or check us out on our website, and feel free to contact us via our LinkedIn or personal email.
That's exactly right. Bill, you just took my little plugs announcement at the end, but thank you again, everyone, for tuning in this week. And as always, please like, comment, subscribe, and we'll see you guys soon. Thanks.